Welcome back to Everyday Economics. The podcast helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can listen to all of our terrific podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording today's episode on Tuesday, August 8th. And joining me, as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, we're kind of catching up on some news. You and I have been on the road, headed in different directions the past few weeks. And last Friday, we're recording this on August 8th. So last Friday, the jobs report came out. U.S. jobs came in at 187,000 for the month of July. And that number came in, I think, pretty close to what the expectation was. But the expectation was that they would be coming in lower. And in fact, that over the previous 12 months, that the U.S. had averaged 312,000 new jobs. And that's according to JP Morgan numbers, but it jives with everyone else's. So what happened here? I mean, we had downward revisions in May and June that took away just under 50,000 jobs. Now, we had the jobs report come in for July at 187,000. And, if trend continues, that number might be revised further down. What is exactly happening in the job market right now?
Oh, look, the Fed raised interest rates by quite a bit in the past year. And so this is expected. The U.S. economy was on fire and needed to cool. And you're right. And so we're now seeing employment growth cooling. And demand is kind of slowly coming back in line with supply. Now, the problem, of course, is that supply is stagnating, right? We're not seeing a ton more labor force participation. I think the labor force participation has been flat for 5 consecutive months now. And so we're not seeing a large increase in the labor force anymore. And wage growth is remaining pretty high, higher than a level that's consistent with 2% core inflation, which is where the Fed would like us to be. And so yes, what does that mean? Well, employment growth is cooling. That's great. We're getting closer to a level where demand will line up with supply, but it's going to take time. It's going to take time because we're not getting a ton of supply increases. We're getting a decrease in demand, a slower and slower decrease in demand. And so it's going to take time for those two things to kind of get to this new equilibrium. And so that's, I think the fear here is that there's still a ton of upside risk when it comes to inflation, because basically parts of the labor market are still in imbalance. You still have a very, very high wage growth. Average hourly earnings are up 4.4% from a year ago, unchanged from last month. And so those wage pressures are likely to continue to fuel some of the price pressures that we've been seeing.
So, all right, so let me ask you this question, right? I mean, as you and I have talked about this economy slowing down and the indicators that are important for us to pay attention to, all of us to pay attention to, not just you and me as we try to sort this out. Employment overall is one of those factors, right? I mean, for people that are out there in the job market, perhaps looking for work or thinking about changing jobs and maybe making one of those sort of career decisions where there's a little bit of risk involved, what insight might you offer them about where the puck is headed here over the balance of 2023?
Right now, the unemployment is 3.5%. So there's not a lot of people looking for work out there today that can't find work. And so that's kind of the reality. Now, where are things headed? The Fed might be tempted to slam the brakes again. And And so, I don't think that will be the right decision. I think things are cooling and are likely to continue to cool. But if they slam on the brakes again, then yes, you might end up seeing the U.S. economy slow. You'll see more slack in the labor market. The unemployment rate could climb, and the Fed, and we might end up missing the runway altogether, right? So like recession risk is receding right now because the Fed is not, is saying, hey, we're pausing, but if they continue to tighten policy, right, they could actually send us into a recession. And at that point, of course, we'll see a large increase in the unemployment rate. And so for people that are out there right now, if you're interested in changing jobs, it's a great time. You still can, because the unemployment is very low. But the labor market is likely to continue to cool on its own. But if the Fed decides that it's not cooling fast enough, the Fed might actually hit the brakes again and really squeeze the labor market.
Yeah, I mean, I think it's worthy of a recap. But I mean, earlier this this quarter, we noted the fact that the Fed had said it was going to, it was pausing, it was not going to increase the borrowing rate, but then it did. It said it would, but it was pausing temporarily, and so we have one of those increases in. We're fully expecting another one, are we not?
I mean, that's what they say. And I mean, we had Michelle Bowman come out and say, I think it was on Monday, that, that basically, the labor market is still too tight, and that the Fed might have to hike interest rates again. And so I think a lot of, not a lot, I think we might be at a point where you end up with a kind of a split decision here as to whether or not tightening is of the order. So we'll find out. We'll see. But yeah, you have people like Raphael Bostic who are basically saying, look, we need to stop, because monetary policy, the impact of monetary policy tends to come with a lag, because headline inflation is coming down, is on pace to fall even lower, and that we're likely to get where we want to be in terms of headline inflation and core inflation, soon. But then again, at the same time, you look at financial conditions. Financial conditions had eased. You look at Goldman Sachs current activity indicator, and it showed basically that economic activity had picked up again, and an increase in economic activity, right, could put upward pressure on inflation again, without a massive increase in productivity. And so that's kind of where we're at right now. Again, I'm of the, look, you look at the latest productivity number, they're actually very encouraging. And so you have productivity growth increasing in Q2 relative to Q2 last year, much higher relative to Q1. Those are encouraging number that should mean that inflation will continue to decelerate. And so I am of the opinion that maybe the Fed should continue to hold and wait and see what happens before slamming the brakes again.
Appreciate that. As always, for Dr. Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.